everybody. Reporting to you again from the Glamour City, Hollywood.
It's early. So, but even if you look at kind of where Patch was and kind of the market was 2 years ago when we were first started in 2020, or I guess it's coming up on 3 years in April, there are a number of durable carbon credit developers. The actual chemical processes themselves, there's actually only 8 or 9 major chemical processes, but the number of developers who are working to operationalize those chemical processes has actually grown quite quickly. Now, that foundation is still small, right? We're talking about going from dozens to hundreds. So there's still a huge amount of work to be done, but I'm very optimistic by the initial kind of early growth rate, if you will. At least when you compare where 2023 is compared to 2020, the number of folks actually working to bring more permanent removal to market has increased dramatically.
If you love listening to this show, please consider giving a rating and a review on Amazon Alexa or wherever you listen. We want to continue bringing you this amazing content, and part of our ability to do that means that we need a big audience. Now, it may not seem like much, but rating and reviewing the show will help more people find us, just like how you found this show. Simply on any podcast platform, search for a show, scroll down to the bottom, and push 5 stars. It's that easy. Thanks for supporting the show. Today I'm joined by Brennan Spellacy, CEO and co-founder of Patch. Welcome to the show today.
Thank you so much for having me, Scott.
You spent some time in development and was part of a startup for a few years. How did you decide to start this new startup, Patch?
Yeah, absolutely. So for those who don't know, Patch is a climate tech software business. And the whole reason I even got a formal education was to actually work in low carbon energy. So I studied chemical engineering nearly a decade ago with the intention of working in geothermal, renewables. It didn't work out coming out of school, and we got jobs in oil and gas in the tar sands in Western Canada, where I'm from. And so instead, I kind of threw the chemical engineering out the window, worked at several startups, technology startups, including Shopify and a company called Sonder. And then it wasn't until April of 2020 that my co-founder and I decided to leave the company we were working at. We had helped grow Sonder from about 20 to about 2,000 people over around 4 years. And we really wanted to apply the things we had learned building these two companies and reapply it back to climate. And so this is really kind of like a coming full circle story for me, essentially.
Yeah, and thanks for correcting me. It was chemical engineering. So when you were growing up, tell us about some of the industries that you saw and your fascination with that industry or sector.
Yeah, absolutely. So, I think the reason energy was always interesting to me is because it always linked to kind of how civilization effectively progresses, right? Whether it's kind of if you look at the kind of total output of power generated by a particular nation, it's typically correlated with GDP, unfortunately, as well as pollution, but as well as all these other positive benefits, whether it's infant mortality, education, things like that. And so this idea of being close to energy and ideally finding a way to decouple energy production from greenhouse gas production was always something that was really exciting to me. And that was why I kind of got into studying chemical engineering in the first place. And it wasn't until probably 2019 that I kind of really started to renew my excitement around working on climate change and mitigating climate change. But when I kind of reopened the aperture, energy is exciting and incredibly important, but I really opened up the aperture and looked at, well, what are the 8 or 9 things that need to be true in order for us to achieve our climate goals as a species? Decoupling energy production and greenhouse gas production, it was one of those things, but there are other problems related to land use and related to kind of air quality. But another one was actually this idea of carbon removal, which is really what Patch is centered around. The whole kind of purpose of Patch is to help scale the carbon removal ecosystem to gigaton scale. And the reason we need that is because we've actually gotten to the point where we've polluted too much, where we actually need to not just reduce pollution or reduce greenhouse gases that we're emitting today, but also essentially bail out the bathtub or drain some of the greenhouse gases that are actually in the atmosphere already. And that's what carbon removal does. And when I realized that carbon removal effectively didn't really exist as an industry, we don't even do a form of permanent carbon removal basis, don't even do a millionth of the capacity we need of the 10 gigatons per year by 2050, that seemed like both a very important, but also really exciting opportunity to maybe help put a dent in.
I wonder if I could maybe kind of rephrase that a little bit in the sense that carbon credits and that market has been around for some time, but I think specifically around large scale sequestration, perhaps maybe that's what we're referring to. And then the other thing from a just broader energy perspective is that sometimes we tend to have a very much kind of an Earth focus. And I think I'm probably one of the few that tends to look beyond even planet Earth. But the emission issue that we're having is very Earth specific to our environment. But let's say that we were trying to harness certain energy sources on the moon or different places like the Mars, for example. It's not the same thing. And I think that's important for people to know, even though it feels a little esoteric, I suppose. It's very specific to our planet and the ecosystem that's here. So talk to us about the legacy carbon credit market and specifically the brokers that were involved in these kind of manual, incomplete processes that would also oftentimes also open up potential risk and liabilities if things were not to go right with carbon credit or attribution, for instance.
Yeah, absolutely. So again, the whole purpose of PASH is to act as a marketplace for climate action. And right now we're starting with what's called the voluntary carbon market, which is really this idea of driving climate finance, where an organization has some sort of negative environmental impact. They want to spend a certain amount of money per ton of carbon they emit, and they give that money to someone who's essentially developing land in a way such that it either abates or removes carbon emissions. So that can look as something as familiar as reforestation, where it's using photosynthesis to draw carbon out of the atmosphere, or something maybe as foreign or human engineered as direct air capture, which are essentially these large industrial machines that suck in ambient air, run it through a solvent, and then basically the CO2 stays behind and the pure oxygen, nitrogen, and kind of some trace gases come out the other side. So the initial idea of carbon markets was developed all the way back in the late 90s, coming out of the Kyoto Protocol. And the kind of initial intent was, how do we, as the global north, drive effectively climate mitigation dollars to the global south, right? How do we incentivize this green transition to less developed nations, where the rich nations can essentially pay for the pollution that they have created over the last 150 years or so? And that was kind of the initial manifestation. And what you realized was a lot of software infrastructure really wasn't built during this first kind of generation, if you will, of carbon markets. Let's call it 97 to 2012 to 2013. And as a result, you ended up in this model where there's a huge amount of capital to develop land, and whether it was through the kind of developing renewable energy or preserving particular types of rainforests, or actually developing new forests, or kind of planting new kind of forms of woody biomass that can store carbon. But there was no like efficient trading or transacting mechanism. And so what we would actually have was these carbon credit developers would essentially sell wholesale their carbon credits to what you mentioned earlier, to brokers. And in many cases, there were actually speculators on the carbon credits as well, where people thought, oh, the price of carbon is going to go up in the future. I'm going to buy as many carbon credits as I can and then resell them in smaller chunks. So it's not too dissimilar from wholesale and retail. So just like you can, buy in bulk at Costco, and then if you go to like a smaller boutique shop, the same kind of jar of peanut butter is twice as much. It's the same kind of dynamic that was playing out. And the end result was so much information from the kind of underlying credits themselves were lost between all of these transactions. And as a result, people didn't actually realize what they were really buying. And in many cases, they were actually unable to perform diligence on the thing they were buying, which in many cases resulted in essentially bad behavior, where these credits weren't actually having the positive environmental effect that they maybe were initially told that were going to have. And so that was kind of the first generation, and kind of how kind of some of the problems that grew from the first generation of carbon markets.
Yeah, and I think the first generation really left a bad taste in people's mouth. And you had, very strange stories of, let's say, a village in a least developed nation in someplace in Africa, where they literally have no combustion engine or any type of electronics, and yet somehow, that little village is supposed to offset, carbon that's being produced in Germany or US, for instance. Yeah. And it's been done multiple times. Now, of course, the issue with the current generation is that there are blockchain-based solutions, and I think there are many solutions or competitors to what you guys are doing that are cropping up every week or so. They pretty much all have similar pitches, and certainly around the blockchain side is this notion of trust and ability to make sure you can have, authenticity, and you can actually have traceability aspects, so that you really know that true offsetting is happening, you can trace it back and you can attribute it back properly from a proportional aspects to the buyer and so forth. But the bigger question I have is, personally, I'm a little bit less enthused about this market just because it's so overcrowded and everybody's saying the same thing. What makes Patch different, and why do you guys stand above the crowd?
It's a great question. So I think that really comes from two kind of core perspectives we have. So the first is actually this idea where one of the reasons we actually got into a lot of the trouble we got with the first generation of carbon markets was people wanted to create effectively a new commodity out of carbon, where there's kind of this idea of these interchangeable, fungible tons, where every ton was created equal. We fundamentally at Patch believe that to not be true. When you look at both chemical, natural, and engineered systems, there's a huge amount of complexity and nuance related to those things, whether it's the actual chemical reaction that's happening. I mentioned photosynthesis and kind of stripping CO2 out of ambient air earlier, whether it's the rate of reaction that happens, how long that positive environmental benefit lasts for, this concept of durability or permanence. There's all this underlying metadata that historically, and a lot of our peers actually try to abstract away to make the buying decision simpler for the end customer. We believe that's actually going to result in, because these systems are so complex, the same bad behavior we saw before. And so the kind of first way Patch is actually fundamentally different is we actually overshare and over-quantify the actual information that's actually underneath the hood, where we have a huge amount of breadth on the platform, whether it's kind of nature-based solutions, human engineered solutions, things that are kind of lab scale, things that are industrial scale, as well as we help quantify all the different types of information associated with it. So really understand what's the stratification within the market and why are some things $10, $50, or $2,000 per ton. Really kind of driving away from that, it's kind of like soybeans, there's only 2 or 3 types of them. Narratives actually, you're buying a particular service when you're purchasing a particular type of chemical reaction. And then the second piece is actually how close we work with suppliers. So instead of operating like a retailer where a lot of folks within the Patch ecosystem actually purchase credits and then resell them, Patch actually has a listing model where we have software that we actually embed in the operations of the carbon credit developer. And so again, that enables us to have a certain level of trust where we have a huge level of insight on how that business is actually run, not just do they have credits or not, but where are the credits coming from? How are they actually selling through? Who else are they selling to? But in addition, we're able to actually essentially be unbiased in what gets bought because we don't actually have a vested stake in the underlying credits themselves. So if you look at kind of some of these kind of blockchain ecosystem players, for example, a lot of them you actually have to purchase the credit and then retire it to then get it on chain, right? So you're actually heavily incentivized to move that particular credit regardless of whether it works out or not, versus a model like Patches where there's actually no position taken within the underlying inventory.
Yeah, I mean, it's a true marketplace. That makes sense. Now, I think one of the basic questions that I think people are asking is enablement that Patch is providing. Are we releasing a net new ability to sequester carbon? Are there, in fact, more nature-based or human engineer projects that we're seeing as a result?
No, it's a great question. I think it's early. So, but even if you look at kind of where Patch was and kind of the market was 2 years ago when we were first started in 2020, or I guess it's coming up on 3 years in April, there are a number of durable carbon credit developers. The actual chemical processes themselves, there's actually only 8 or 9 major chemical processes, but the number of developers who are working to operationalize those chemical processes has actually grown quite quickly. Now, that foundation is still small, right? We're talking about going from dozens to hundreds. So there's still a huge amount of work to be done, but I'm very optimistic by the initial kind of early growth rate, if you will, right? So past results are not always indicative of future results. And so I think we should still be cautious. And you mentioned some macroeconomic trends earlier, and we can kind of circle back on that if we like. But I think at least when you compare where 2023 is compared to 2020, the number of folks actually working to bring more permanent removal to market has increased dramatically.
So there's a number of external factors that's happening. One is the fact that I think all of us at this point have experienced extreme climate change. I mean, I think just even for us, there was a tornado that came through very close to New York, for instance, to San Diego that's getting snow and Los Angeles area as well. So clearly, I think people are feeling the pressure and recognizing the changes very much at their doorstep. But at the same time, you also have these macro geopolitical factors, that is inflation, rising interest rates, to just the overall kind of recessionary down market. And that is also crimping the kind of budget that would have been typically allocated for these types of tools and capabilities and tracking and reporting, but also the people that used to manage them that have been laid off, or that those teams have been, halved or quartered, for instance. How does that affect not only your business, but the effort that we're trying to make on a global scale?
That's a great question. And I think it's one that we think about all the time. I think the thing to understand is economic cycles are just that, they're cycles, right? Then there's smaller economic cycles that are typically 10 to 15 years long, and then there's longer debt cycles that are a bit longer. The kind of general trend of climate change, though, traverses cycles. And so what's really important, especially if you're working in climate tech and you're kind of entering kind of what could be perceived as a more difficult economic time, is focusing on businesses that are actually just candidly thinking long term and a little bit less sensitive to interest rates, right? So for example, we actually don't work with growth stage tech very often. They're very sensitive to interest rates, right? I think we're seeing that right now, where a lot of my positions in software companies are down 50% year over year, versus like working with organizations like banks, insurance providers, even in some cases, not always, like healthcare companies that are a little bit more, that have stronger balance sheets and have a little bit more understanding of what the next decade plus is going to look like, as well as they have that climate ambition as well. And so I think, in the short term, economic cycles are always going to affect you, but that doesn't actually take away from the longer term strategy of this is something that needs to be on top of kind of the 3 to 5 bullet points in a particular board meeting. Secondarily, it's actually an opportunity for a company like Patch to shine, where we talk all the time about Patch actually enables you to have a robust of a carbon program as Microsoft's with one person instead of 20, and you can get it done in a couple of weeks instead of a couple of months. And so from a pure cost savings perspective, in a situation where you might need to have some sort of headcount reduction, you don't actually have to sacrifice on the efficacy of a carbon program using software like Patches, because software gives you organizational leverage.
Yeah, no, it makes sense. Now, the thing is, Patch was founded during the really kind of the height of the market, or height of the market, and certainly some of your backers are really very prominent, tier 1 VCs, but also even kind of larger PE players that have moved down into the VC category. But that, I wonder how that establishment in the heydays of the startup, and now where we are today, how that affects you guys as a firm, and also change maybe the culture.
No, it's a great question. So, Aaron and I think have been very fortunate. I think it's like it didn't seem immediately during COVID, but it became very obvious in retrospect that it was actually a fantastic time to start a company. And we've been very fortunate to have a really great list of backers, like you mentioned, whether it was Andreessen or Kotu or any of these folks in our corner. I think as far as the culture, we actually haven't changed our culture that much between kind of before and after. And the reason for that is Aaron and I, having worked at Sonder, which was I actually absolutely love that business, but it's a cash incinerator. Like that company took a lot of capital. It was incredibly difficult. And we were always in a financially precarious position, even during boom times. And so as a result, we've kind of, I think, have that scar tissue where we were always a little bit, the dancing is going to end at some point, and there's always a little bit of paranoia and errands in my mind. A decade or a year and a half ago, we were kind of getting told, calm down, like things aren't as bad, stop being so concerned. And now it's just you're acting like you should be. So I think it's more related to how people perceive how we operate rather than actually changed how we've operated. Good.
Let's talk a little bit about your solution in the context of different verticals like e-commerce,
Sure.
travel, fintech, and supply chain, and so forth. And where are the sectors that you're seeing, let's say, more percolation versus not, and maybe there's others or that are kind of lagging behind?
Yeah, it's a great question. So, the core idea behind Patch is to give you both the most kind of breadth and insight on interacting with the voluntary carbon market, as well as being flexible and meeting you where you are and how you want to transact. So what that basically means is Patch is multi-medium. So we have an API product, we have a visual product, we have a series of hosted or managed account products, as well as we have many different types of transactions. So there's a spot transaction, which is kind of like buying over the counter, as well as this concept of a long-term offtake agreement, which is a multi-year contract. That's typically how enterprises buy carbon. If you want to not be surprised by the fluctuations or changes in carbon pricing year over year, you might lock in a 5 or 10-year contract. Patch makes it really easy to create one of those agreements as well as service it. And you can essentially combine these dimensions however you want. So if you want to create an offtake via API or spot purchase in the UI, et cetera, you can do that. And so what we've seen is we've had a huge amount of success working with organizations, typically that are closer to money, actually. And what I mean by that is whether it's like private equity firms and asset managers. So organizations like EQT, for example, $100 billion PE shop out of Stockholm, or some banking partners, some of which aren't public yet, but other organizations like RBC, for example, the largest bank in Canada, that are actually embedding climate action into a product or service that they actually have. As far as lagging, it tends to be primarily organizations either that are, at least in the short term, like the biggest kind of implementation to intent gap is probably actually in a lot of tech right now, where there's a lot of excitement about doing something. But if you've just gone through a 10, 20, 30% RIF, it's hard to kind of justify this type of expenditure. And the organizations that are really dragging their feet tend to be energy companies. So they waffle actually quite often, where there's, the kind of mood or energy of an oil and gas company sometimes is we want to actually actively play an active role in this. But then you'll have organizations where I forget exactly which oil and gas company did it, but they actually just pushed out their climate ambition by another decade and reduced the target pretty dramatically. And so it's quite this group of companies tends to be quite mercurial, I find.
So in terms of a roadmap and as well as a business model, is certainly the marketplace makes a lot of sense, and consuming it via API services so that it's pretty much embedded into anything and everything that they do. But when you think about not just secondary markets and talking about the capital markets, but like think about OTC and some of the broker to broker or bank to bank type of transacting platforms, have you guys thought about from a product roadmap and a business model to be more on the transactional side so that you guys are actually providing some of these trading capabilities almost?
Yeah, no, it's a great question. So I think right now what we're really catering to, and the kind of mission of the business, is to grow voluntary carbon markets through a way that actually has positive environmental benefit. And so we are not necessarily against trading, but if it's through the lens of large capital, pools of capital, funding new types of project development, getting a stream of credits, and then reselling those credits. And we're actually actively building software that enables that. What we want to avoid, or not necessarily avoid, but we're not going to be particularly catering towards, is organizations or shops that want to speculate on carbon. So you're not developing net new carbon, you're simply just buying and flipping. We're not going to be really building software for those organizations. But what we are noticing is banks particularly really want to play a role in both purchasing carbon themselves, financing carbon development, and getting payment in carbon credits so that they can sell it to their clients. We're very much going to be pushing into that world.
I'm glad that you guys are not just supporting hedge funds. That's good to hear. Any last comments about where things are going and what you guys hope to accomplish?
No, I mean, I think it's just, even with the kind of ups and downs of the macro, it's just a really exciting time to be working on climate. I think if I were to leave anyone with any kind of thoughts, I think the kind of mission critical element here is we're unfortunately in a situation where we have waited too long to act in many cases. And so in a lot of conversations, they tend to relate to climate change. They tend to be very zero sum. We have to do solar. No, we have to do nuclear, versus we have to do decarbonization and we have to do carbon removal as if an either or, because it's presumed that there's a finite pool of resourcing to gain access to. And that tends to be the reality. That being said, we are not spending enough by an order of magnitude on the energy transition per year right now to get ourselves out of this situation. And so for me, I'm much more of an advocate of having the conversations around how do we actually increase the annual investment as a planet, as a species, rather than how do we actually chop it up, right? We spend about $800-900 billion a year. We need to be spending $3-4 trillion a year. How do we get closer to that $1 trillion number rather than figure out how to slice up? There's just fundamentally too small of a pie. So if I were to leave anyone with anything, it's how to focus your energy on that, especially if you're debating with your peers or debating online, that's a much more exciting and candidly constructive conversation than speculating on which R&D bet is the one to take. Because at the end of the day, you actually have to take 1,000 swings because 100 are going to work and 10 are going to scale.
Yep, we've had a number of different guests on show that have talked about that side of the market as well. So with that, I have been joined by Brennan Spellacy, CEO of Patch. Thanks for joining today.
Thank you so much for having me, Scott. Really appreciate it.
If you've enjoyed this episode, take a moment to rate our show on any podcast platform that you listen to. Scroll down to the bottom and push 5 stars. It's that easy. And as always, thanks for listening.